Why do futures exist? Katie, go.
It's so funny when you sent this over to me because I started to think about like the fun trivia that Pete would do, like when I was first learning, right? Of like, oh, what were the first like futures products and stuff like that. And my first like response to this question was they originally existed to like exchange, I believe, just like different commodities. It was like rice and eggs and something else that I'm completely forgetting. Do you know like what they were?
Don't you flip this on me. First of all, Pete, God rest his soul. We didn't, that was fun for you. That wasn't fun for
Hey,
me.
I like
But
a little fun fact from time to time. Like, you
but
know,
that's classic. What I just tried to do was catch Katie off guard there. Why do futures exist? Go. And then she very astutely flips it right back on the question master. You're exactly right, though. They were created. I think some of the first futures date back to hundreds of years ago in Japan to settle to hedge risk from rice farmers. And then here in the US, I think some of the first futures contracts here in the Midwest, around Chicago, St. Louis, or wherever, to hedge grains, different grains that were in the ground or soon to be in the ground, but not ready to go to market. How can we hedge some of the volatility in the price in February, March, when we know we're not going to have this stuff until, several months later?
but now, like the producers are a small subset of who is participating in the futures markets. So, yes, that was the past, but now obviously they're used much more for people. I mean, of course, institutions, but people also like you and I that want to speculate on the various prices of all the futures that are available.
Absolutely. Some of the biggest growth that we've seen in any part of the financial industry is retail traders taking on derivatives products like options and futures for their own speculative needs or their own, risk management needs. Just there's been an overwhelming trend, Katie, of getting away from traditional finance and, paying money managers and everything else and accessing these different things on your own so that you can try to make a decent return year by year. Now, futures are at their core leveraged versions of popular markets. It's with great rarity that you see like a futures market innovation, Katie, that is like, oh, wow, these people just created a market out of nowhere. It's mostly like, I like to talk about it as like those types of inventions that make your life more convenient, but don't necessarily like reinvent like anything. It's not like going from a flip phone to a touch screen like iPhone. It's just like, oh, we took that phone and we made it cheaper or we made it easier. That's basically what futures do. And you see here, you've had the S&P 500 benchmark, the index, for decades and decades and decades. You've had the S&P 500 futures for a fraction of that time. And now, within the last year or so, you've got the micro S&P 500 futures, which are just those 500 stocks, but in a futures form, which is to say a leveraged form, right?
Yeah, exactly. You are putting up less capital. And that's one of the benefits of futures trading, right? Is you have that higher potential return on capital because you're controlling more from a notional perspective than what you are required to put up to hold or maintain that position.
Exactly. And there was a wonky period when this trend of everyday people taking, taking finances into their own hands was at early stages in, the mid aughts into like 2010, 2012 and everything like that. There was this wonky stage of like, oh, I'm getting into options, I'm getting into futures, but I'm using futures that are primarily created for big banks or big, corn producers like we talked about, and they're big products. And so that leverage idea, Katie, I think scares a lot of people off because when it's applied to a big product, you're talking about a lot of risk. Now, the micros, for instance, they give you $20,000 worth of the 500 stocks in the S&P 500 for just $1,400.
Right.
that's
And I
still a
don't, oh,
pretty
go ahead.
big amount. Sorry, that's still a pretty big amount, right? But it's not as big as the bigger futures, $200,000. It's a little bit more manageable, right?
Yeah, exactly. And I'm sorry for interrupting, but that's kind of what I was going
No.
to say. Like from my time on the support desk, I don't know what like the average account size is nowadays, but what my perspective or what my experience tells me is that we would get people that would write in all the time of, hey, I've got, $25 to $50,000 for a trading account. Like, what should I think about doing? Or like, how should I position myself to not get too big, to like abide by those pillars of trading small? And so like with these futures products that have now evolved to be more digestible to somebody like you and I mean, there's just so much more power and flexibility in what those people that are in small accounts can do.
Absolutely right. And we like to always like a back of the envelope math is always like the margin on your futures or options trade should probably not exceed 1 or 2 or 3% of your account size, which makes it really a lot easier to trade these futures and options and everything else. When you're talking about here, a STIX product, a small exchange product, even smaller here, controlling $5,000 worth of 60 technology stocks for just $500. And so you can gain access to these futures with an even smaller account. Now, why would I do so? And a lot of the opportunity, Katie kind of alluded to it to start, comes in short-term trading, day trading, or swing trading in a certain like a 3-day period or what have you, whereby since I'm putting up a smaller amount of capital, Katie, I can have a trade on for just a day or two, look to make $50 or $100, return that on, just $500 in margin here. Yes, I'm taking leveraged risk, so it's more risk, but I'm taking it for a shorter amount of time. And thus my returns are still, potentially 10%, 20% return on capital. And we primarily use this standard deviation, right? To measure when a market in a given day here moves outside of its standard deviation. We'll sell it if it's higher than the one standard deviation to the upside, hoping that it comes back in line. Or if it moves lower, like a day like yesterday in STIX, we'll buy it, hoping that it comes back in line here and, make 40, 50, $60 with decent returns. And you can do this in your platform too. We've got the small exchange statistics here for small exchange members, but you can also attribute it to your platform by going into the indicators and adding anything to really do with standard deviations and messing around with that.
I was going to say, I love that you kind of added this last little slide because as you and I know, this is the most popular question of like, where do I manage my profit targets? And you and I alone have done several segments on taking that standard deviation or 2 standard deviation move and then fractionalizing it to get a realistic P&L. So this also takes out, some of the guesswork for you in terms of like, okay, this is the current P&L or standard deviation. Here's what I can reasonably expect to make if I'm doing a day trade or a swing trade.
Absolutely right. Standard deviations, just like the implied volatility is to options, standard deviations is to futures. When you might enter a trade, what looks attractive, and also when you might manage it. And you can almost any platform find a simple standard deviation calculator, apply it to your charts or wherever, and it'll give you a nice little number to work off of when you're trading futures. But that's that, Katie. That's enough here out of you and me on small stakes. Thanks so much for joining me, Katie McGarrigle, and thanks so much for everybody watching out there. Stay tuned for Splash into Futures coming up next. Have a great night, everybody. Peace.